Iceland is considering a revolutionary monetary proposal, taking the power to create money from commercial banks and giving it to the central bank. Professor Matthiasson, it has been said that Iceland is a poster child for the current monetary system's weaknesses. Would you say this is fair?
The banks utilized their opportunity to operate anywhere in the European Economic Area, but the regulatory framework was not fit to control their activities. The UK financial oversight authorities were not looking at them properly. The Icelandic financial oversight authorities were not either. And they did not have the capacity to do it properly. But now some of those structural problems in the oversight sector have been overcome. So I guess it is harder for any other banks to come and play the same game as the Icelandic banks did.
The chairman of the Economic Affairs and Trade Committee of the nation's parliament and the Prime Minister commissioned the report Monetary Reform, a Better Monetary System for Iceland, which proposes a version of the sovereign money model of banking. While revolutionary, isn't this a bit simplistic?
It is simplistic. There has been some confusion on the status of this plan outside of Iceland. The chairman has been advocating less fractional banking, so to speak, for a long time. The chairman is an engineer by education, and with him on this ad hoc committee were two economists. In the end, only the chairman did write a report, and the two economists did not want their name on that report. So this is a bit unusual. A member of parliament works as a researcher for himself, together with other researchers, and they do not write up on the final product. So this report does not have the status as it has been given outside of Iceland.
But if the monetary policy went ahead, do you think that would be good or bad for Iceland?
Well, I think it would probably lower the potential growth for Iceland. It would be harder to do finance, and firms and other entities would have to find alternative ways of intermediating finance between themselves, and those new ways of doing it would probably be much more costly.
It has been suggested that this monetary reform is an attack on fractional reserve banking. What sort of ripple effects could this have if successful?
The plan only considers money as means of transaction, but ignores its role as store of value and also value of being able to transform illiquid with high-earning assets into liquid assets. If this plan was brought into action, I assume that some form of unregulated shadow banking institutions would overtake many of the store of value risk alignment issues.
Surely this is going to hit banks' fee charging abilities. Won't we see a lot of banks struggling again?
And also we would see the institutions that shadow banks pop up all over the place, and and they would be unregulated, and I am afraid that it could hurt ordinary people, ordinary businesses.
The Supreme Court has ruled some forms of loans in foreign currencies illegal. Isn't this a form of protectionism that could irritate foreign lenders?
It's mainly a manifestation of how badly lawmakers in Iceland did their job when writing the law on indexation of loans and such things. In that law, they allowed loans in foreign currency, but banned loans that were tied to basket of currency, that is to a currency index. So if you ask an economist what is the difference between those two things, and the economist will wave his hands and say there is no difference. But the lawyers did find that difference in the form. So the whole thing is a bit silly in my opinion.
So finally, does Iceland have the cure for bad banking then?
Iceland has been the source of much bad banking through the years, so I wish I could answer this in the affirmative, but I am afraid that I must just say no.